Hey guys, today I will be going over the best way for beginner investors to pick the right stocks. Before we get started, welcome to Hip Finance. My name is Dylan Hippensteel and I go over what I feel are great financial tips and tricks, as well as any new financial news that is going on in the world. I post videos every Monday and Friday, so be sure to hit the like button and subscribe so you don't miss out on any new videos. And just as a disclaimer, this is not financial advice. Most people don't realize it, but stock markets are the backbone of the economy. With that said, stock investing, when done right, is the fastest way to secure a wealthy financial future for yourself. In case you're a beginner and don't know much about the field to get started, then you've clicked on the right video. Today, we'll be talking about the right way for a beginner investor to pick stocks. You'll find out the best way to put your money to use, so keep watching. So let's start off with the basics. In technical words, investing means buying tiny shares in a public company. These shares are the company's stock. The idea here is that you invest your money in the stock, the company grows with time, and the stock gets more value, and you get profits. If the stock proves to be really valuable, you might find yourself approached by other investors, offering to buy the stock for more money than what you've paid for. Famous investor Warren Buffett said that investing is the process of laying out money in the present to receive more money in the future. So, how do you go about making money by investing in stocks? Well, here's a step-by-step guide. So step one is decide what you want to do. Before you do anything, you need to figure out exactly how you want to approach stock investing. There are 3 different ways you can do so. You can either go for a hands-on option where you choose stocks and funds on your own, or you go for the hands-off option where you have an expert manage the process for you. There are robo-advisors, brokerage firms, and independent advisors that offer their services for a minimal fee. The third option includes investing in your employer's 401k. For those of you who don't know, many employers offer a 401k, which is a retirement plan where you can deposit pre-tax dollars from each paycheck into a retirement account. In this case, you have the option to choose between different investment options. Step 2 is to make an investment account. Once you know what kind of approach you want to take to investing, the next step is to make an investing account. Making one is absolutely essential because it allows you to put your money in a place where you can use it to sell or buy stocks. You can take one of the 2 routes for opening an investment account for yourself. You can open either a taxable brokerage account or a retirement account through a broker. Both of these accounts have their list of pros and cons that the broker would be more than happy to go over with you. The second route is through a robo-advisor. If you choose this option, you wouldn't be required to do any of the work. These advisors provide complete investment management, allowing you to take a back seat. Personally, I don't like this option just because I like to make the decision myself based off of my own research and knowledge, rather than depending on someone else, but whatever works better for you is the route you should take. Step 3 is the most important of them all, and step 3 is to make sure you crush the like button before watching the rest of the video. But in all seriousness, here's the real third step, which is also very important. Step 3 is to learn about the different types of stocks. With your account set up, you're ready to make some purchases, but you need to hit the books and learn about your market before you do so. There are 3 types of stocks for you to invest in. The first one is individual stocks. If you're going for these, you should know that you've got a lot of work in store for you. You'll be looking at quarterly earnings reports and mathematical calculations to find the best one for you. The second one is index funds. These are investment products that aim to match the performance of an underlying index. These funds have relatively lower costs, but do bring in a significant amount of money if you manage to land a good one. And now third is a mutual fund. Buying these mean you're essentially purchasing small pieces of many different stocks in one go. These are a great way to diversify your portfolio as compared to individual stocks that are more put your eggs in one basket kind of thing. Personally, I've invested into ETFs for long-term investments because I'm putting this money into the entire market as early as possible so I can get that amazing benefits of compound interest. Personally, I myself invest into VTI, but there are many ETFs out there for you to invest in. Now, step 4 is to set aside the money. A little piece of advice when you're going to start investing: don't use money that you're going to need in the next 5 years or so. This includes money you're going to use to pay your child's tuition or emergency funds. When you're done paying off all the essentials, the money you'll be left with is the one that you should be investing. Now, you don't need a lot of money to start off. ETFs are generally cheaper and you can get some for around $100. As for the maximum range that comes to buying stocks, well, the sky's the limit. Now, step 5 is to manage your portfolio. Now, you might feel like just sitting on the couch and relaxing after you bought a couple of stocks, but you can't exactly do that. You need to revisit your portfolio from time to time to see that it still aligns with your investment goals. That means dumping dead stocks and finding new ones. What's more, you need to always be on the lookout for new promising stocks on the market. When you've got enough experience, you can look into international stocks as well. Overall, your aim should be to diversify your portfolio and continue investing. Now that you know some of the basics of investing, the next question that comes up is, how do you pick the stock that benefits you the most? All of those endless balance sheets and charts can drive you nuts, but here's a guide to make things smoother for all the newbies out there. Number 1 is price to earning ratios. There are a lot of ways for you to judge whether a stock is good or not. The best indicator is the price to earnings ratio. The price to earnings ratio measures a company's value by telling its current share price relative to its earnings per share. These ratios are used by investors and analysts to determine the value of a stock. Generally, stocks with high PE ratios are favored as compared to those with low PE ratios. A high PE ratio means that the particular stock is overvalued and you can expect a high growth rate in the future. Number 2 is price to earnings growth ratio. A PE ratio alone is not enough to determine the stock value, which is why investors also use the price to earnings growth ratio. This is a ratio of the stock's price to earnings divided by the growth rate of its earnings for a particular time. This is symbolized normally as PEG, or a PEG ratio. The PEG ratio also helps you better compare the stocks of different companies. The higher the PEG ratio, the better. However, you should know that the PEG ratio tells you where a company has been in the past. You don't know if it'll be growing at the same pace in the future. Now, third is price to book ratio, or P/B. The price to book ratio is yet another ratio to help you value a stock. It measures the market's valuation of a company against its book value. Market values are typically higher than the book values. Book values tend to center around the company's physical assets and stock holdings. The price to book ratio essentially tells you what the company will be worth once it loses its market value. Stocks with low price to book ratios are considered good, and stocks with price to book ratios under 1 are considered to be solid investments. Now, number 4 is dividend yield. Dividend paying stocks attract a whole lot of investors since they promise a paycheck even if prices drop. The dividend yield tells you the percentage of share prices that a company pays out in dividends each year. Investors tend to avoid companies with inconsistent dividend yields in the past. Dividend yields don't stay constant. They can vary from industry to industry as well as with the company's performance. So, how do you find good stocks? Finding a good stock for yourself is the equivalent of finding a needle in a haystack. You'll know what to look for, but you have to go through the task of painstakingly looking at each one. To make things easier, here's a quick glimpse at what professionals do. Smart stock pickers have 3 things in common. 1, they know what they want their portfolios to look like and they don't deviate from that. 2, they keep up with the market. And 3, they use their goals and relevant information to make their decisions. The takeaway from these qualities can be summed up as follows. 1, determine your goals. You really need to be aware of your goals if you're going to choose stock for yourself. Are you more income focused? Do you want to preserve your wealth? Or do you want some capital appreciation? Income-oriented investors tend to go for stocks that pay out good dividends. You'll find such stocks in bonds and real estate investment trusts, or REITs. Investors aiming for wealth preservation go for stable blue-chip corporations. Their investment policy is low risk. They tend to go after consumer staples since their stocks tend to stay stable through different times. Now, investors for capital appreciations zero in on stocks that are in their early growth years. Of course, going after such companies comes with huge risk as compared to those other options. Number 2 is keep yourself updated. One of the best things you can do for yourself is to keep yourself updated. Reading financial news and keeping up with blogs should more than help you in this regard. You should also keep a close look at what all the big names are up to. They usually know what they're doing. However, choose one whose investment goals align with yours, but try not to turn into a mindless cult follower. Always use your own head when it comes to investing. To make the grueling research process easier, here are some more tips. One tip is to identify companies. You can come across more companies in 3 different ways. 1 is to look for exchange-traded funds of companies that interest you. Look at what they're investing in. You simply have to Google industry whatever ETF. And when you do this, the search engine will take you to the listings of the fund's top holdings. Doing so should give you a pretty good idea of where to invest your money. 2, you can always take the help of a screener. Screeners are a set of tools that filter out stocks based on a specific criteria such as an industry. You can even make it more specific by incorporating factors like dividend yield, market cap, and other investment metrics. However, keep in mind that these screeners can be prone to error. And last, you can also skim through stock analyst articles and commentary pieces on companies you're going after. Remember to seek out opinion pieces that show you both sides of the coin so you can form a well-informed opinion. The above 3 steps should give you a starting point for your stock hunt. Each of these comes with your own set of pros and cons, so try not to rely on one and instead use all 3 for your advantage. Once you've found an industry that interests you, you can review their company presentations. These are easier to digest as compared to financial statements and can also save you a lot of time. These reports also do a pretty good job of telling you what direction the company is heading in. So I hope you found this video helpful. If you have any questions, ask away in the comment section. I'd be more than happy to take them. Also, make sure to leave a like, subscribe, and turn on that notification bell so you're notified every time I post a video. I also link my Instagram, TikTok, and Twitter in the description below, where I post short financial tips and tricks if you want to check that out as well. Thank you guys for watching, and I'll see you in the next video.